Welcome to today's webinar on commercial real estate in 2021 and beyond. This event is organized by the European American Chamber of Commerce, New York, where Europeans and Americans connect to do business. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC, and I will be your host for today's event. Today's program will address the fact that the economic shutdown resulting from the pandemic is cast long shadow on commercial real estate. This is across the country and across Europe and really worldwide. And we have two real estate heavyweights as on our panel who will provide a data-packed update on the developments in both retail and office sector and how they affect the corporate bond market. The panel includes Annemarie DiCola. She's the CEO of Trepp, a global leader in the CMBS industry. Annemarie spearheaded the firm's expansion to offer solutions in CRE finance, banking and corporate, credit CLO sectors. And under her leadership, Trepp acquired CRE finance data firms Foresight Analytics and InvestCap Advisors, as well as Rate Cafe and Commercial Real Estate Direct. And Trepp has been honored a few years in a row now as the Global Capital's CMBS Data Provider of the Year. We also have Troy Merkel, who is a partner and real estate senior analyst at RSM. Troy has 17 years of experience in audit and consulting with an emphasis on real estate and financial service reporting. He's also an expert in accounting for assets acquisition and complex leases, and he specializes in various tax advantages, in particular opportunity zones and government subsidized deal structures. I will hand over to Annemarie, who's going to get us started off. Annemarie, over to you.
Thank you so much, Yvonne. And as always, it's a pleasure to work with you and to speak with the European American Chamber of Commerce. And to my co-panelists, Troy Merkel, a pleasure again to be doing this presentation with you. Troy and I did this presentation back in the summer. And of course, with the rapidly changing events around us, we have important updates to report to all of you today. Troy and I thought that once again, it was good to begin this presentation with an overview of the economic impact of this pandemic. And there's a few slides here that I draw your attention to. If we look at the upper left and the two slides on the left-hand side of this, we're looking at some important data in the US. This first slide on the upper left details what occurred with US retail sales. And what we see when we look at the 2020 bar, we see retail sales plummeting and then rising again. And this, of course, reflects the headlines that we've all lived through, where you see that once the economic shutdowns occurred, businesses being made to shut down for health and safety reasons, retail sales plummeted. And once there were reopenings that were permitted to happen, the pent-up demand resulted in that rise. As a result, when you look at US GDP below that, again, you see the precipitous drop and a rise once again. And this is completely reflected in the yin and the yang of what has taken place this year with the impact of those lockdowns. If you look over to the right, once again, the headlines we've lived through are jumping through the numbers here. When you look back at the March timeframe, just prior to the onset of the lockdowns in the US, you have extremely low unemployment claim rates. And then once the lockdowns began in March and were further felt in April into the beginning of May, you see those incredible numbers of jobless claims. The peak in the last week of March was 1 week when unemployment claims in the United States were at 6.8 million in 1 week. Things appear to have stabilized, as you could see by those fairly steady bar heights as you get into September and following. But I want to point out that the numbers in those bars, as of November 28th, unemployment claims were still at 712,000 down from 778,000 the week prior. And so those are still incredibly high numbers of jobless claims, unemployment claims in the United States. And as we know, we are not out of the woods yet. While the news about the vaccines are good pieces of news for sure, we all understand from the coverage we've seen that that is going to take a long time to be administered and to begin to have knock-on effects of greater movement back to some level of normalcy. So we have more wood to cut.
Yeah, and to add to that, Annemarie, I mean, to put that into perspective, that 712,000, when you look at that chart and how astronomically high we went early on in this pandemic, you look at it and you go, okay, things are a lot better. To put that in perspective, during the Great Recession, 2008, 2009, we're still above any of the highest peak weeks there, which tipped out about 680,000 jobs.
Yes.
So even the best week of the last 9 months is worse than the worst week we had during that time. So it just shows you how challenging it is. And while that has sloped down, the jobs numbers, the regaining of jobs, the furloughing and coming back has slowed precipitously as you looked at the last month of data. So we're not out of the woods yet. I would expect some of those numbers to rise as we go into further lockdowns. You see what's happening. The state of California, 85% of the population is under a stay-at-home order for the next 3 weeks. And that includes many small businesses. So we're seeing more and more of that being rolled out across the U.S. And I would expect that the next few months, these numbers are unfortunately going to rise back up. Hopefully not at the level that they did in early 2020, but we're definitely not out of the woods, and we have a little bit more to go through.
Agreed completely. And one of the themes that you will see us reiterate a few times in this presentation is a compare of where some of these levels are versus the worst of the financial crisis. And it is a staggering compare to see because it speaks to the velocity and the intensity of what has occurred in the US this year. Troy, if we could move to the next slide. While our presentation is overwhelmingly on CRE, we thought it would be interesting to show some important trends from the corporate CLO market, because as we know, everything is connected. So Trepp covers the corporate credit CLO market. And one of the things we have seen by looking at the impact of that market is, like the CRE market, certain industries have been bearing the brunt of what has occurred because of the pandemic. These industries are retail, hotel. You're going to hear a lot about retail and hotel lodging today, gaming and oil and gas. And a few stats from the corporate credit CLOs. A certain type of financing that's meant for companies that are in bankruptcy is a debtor in possession loan. And when we looked at our CLO database at Trepp, we saw that over 50% of the DIP loans that have been issued since March are backed by companies in those 4 sectors. So those 4 sectors are in trouble, and therefore the real estate that they inhabit, those pieces of real estate, are in trouble accordingly. Another example of this is when we look at loans that are trading below 80 cents on the dollar. Over 30% of the loans that are trading at that level, which we consider a distress level, again, are in these sectors of retail, hotel, gaming, and oil and gas. So again, something that does not bode well for the associated real estate that these sectors inhabit. With that, Troy, now why don't we move to the next slide?
Yeah, and so some of the trends we're seeing overall is there's sort of this K-shaped recovery that Annemarie was referring to there, where we see some industries such as housing, some technology industries, delivery, Amazon, many of the, you look at the stock market, it's hit new highs, passing over 30,000 on the Dow. Some companies are flourishing right now, and we're seeing that rocket ship recovery. Meanwhile, you have other stalwarts in the hospitality and service industries, and also a lot of what we like to call, the real economy, the middle market companies that are there, the private companies, the family-owned, family-run businesses that have just been decimated and are not seeing the recovery. And as they go into further lockdowns, they don't know that they can withstand another few months of reduced retail, reduced foot traffic, reduced customers. So there's a real difference in what's going on in the economy over there with regard to it. And then, you see the Sun Belt and the suburbs, people are fleeing many of the urban developments that have been really the catalyst and attracting many of millennials over the last few years. Cities like New York, the San Jose, San Francisco area, where prices have gone through the roof on apartments. We've seen them actually drop dramatically, 10-digit drops, between 10 to 12% drops on apartment rates year over year in many of those metros, as people are moving out into the suburbs or making drastic moves as work from home looks like something that could be more prevalent in the future, and they're moving to new metros that offer more affordable living and oftentimes better climate. One of the other things we're starting to see is, continued trends on big data, leveraging big data. People have gone from, in real estate, where you used to report quarterly and that was fine, to people were needing weekly information. Investors needed to know what's happening in their buildings, how many people are going to the buildings, where are people going in their buildings. And that started to bring in the proliferation of the Internet of Things, which was already sort of starting to take traction, but now contact tracing, thermometer checks at entryways, things like that are now becoming more prevalent, and also tracking where and how people are using their buildings so that if they need to evolve it, they can evolve it intelligently. Environmental sustainability and governance continues to be a hot topic. We've seen a number of hurricanes and continued natural disasters throughout 2020, in addition to the pandemic. There's a lot of flood risk, and buildings that are in certain planes need to be analyzed to figure out if they are at risk, and so that's a challenge. And then finally, there's going to be some significant policy challenges likely coming on the horizon with President-elect Biden coming into office. He has made many commentaries about the real estate industry during his campaign. The most prominent one is regarding capital gains tax and long-term capital gains tax. Historically in the U.S., if you had an investment that was held for over a year, which many times real estate is, you would benefit from a reduced capital gains tax of 20% below the potential median, the individual tax of 39%. And so that's going to have a significant difference in the after-tax IRR and cash return on many real estate investments. There's also other things such as 1031 exchanges that allowed tax sheltering on gains and transition of property asset values. Opportunity zones have been a large investment class, and there's going to be looks at modifications and increased reporting. There was also issues with large SALT taxes, which state and local taxes, where they were not provided as a deduction for the federal government anymore, and that had impacts on the housing market. So there's a number of things there that could shift the way real estate investments are calculated, and these are tax policies that have been in place for 30 years. 30, 40 years. So many of the people in the industry have never lived without these taxes being in the way they are, and real estate is often a tax shelter and a tax advantageous investment. And finally, infrastructure packages. This is going to be a fascinating one as we look at how travel progresses, what airports look like. I've seen figures that it's not until 2024 or 2026 that they expect air travel to reach back to what it was prior to the pandemic. And even then, it's going to change. We look at corporate travel right now. Annemarie and I do more web conferences than we've ever done before. And I was on a plane pretty much every week before the pandemic. So my life has definitely changed. My frequent flyer miles are not where they were. I miss some of the travel. I do enjoy being home with my family. And there are perks of staying at home, but ultimately the industry and hospitality industry is going to really have to adapt to losing what it was a bread and butter, which is business travelers. And that allowed for affordable personal travel. So we'll see how the infrastructure package goes and the investments there. And we expect a lot of that to be in technology and energy infrastructure. moving on, sort of talking, and I'll talk a little bit about some of the real estate dry powder and some, I'll dabble in some of the CMBS. I always get intimidated with Annemarie on the phone if I'm going to talk about CMBS. But when we look at the dry powder, we've seen a ramp up as over the last decade, real estate was doing phenomenal. Basically, all metros, it was just a matter of how well you were doing. And while certain asset classes such as multifamily and industrial were incredibly hot and remain so, downtown core office was doing well, build-to-suite office, experiential retail was doing well. We were seeing the reimagining of strip malls and retail centers to have entertainment as a component of it. And as such, capital continued to flock to the market. As you can see, there's a dip in the dry powder that happened in 2020. And that's to be expected as fundraising sort of petered off as people now are pausing. Investors are wondering what is next. And it's challenging because I think for the first time that I can remember, ultimately you have to be a sociologist instead of just a real estate investor and reading the real estate market. You need to read the psychology and sociological impacts that are happening here because of COVID. And you can continue to see here, we talked, and Annemarie mentioned, and we'll go into it more in depth, but really retail and hospitality is where the delinquency has risen dramatically. You can see here since May, it has shot straight up. And that's with a lot of forbearance actually in the market. And so there's still been a lot of leniency given by the lenders, and there's going to be some challenges ahead. Here you can see, so this is the fundraising. It tells two stories. One, we did talk about fundraising is down this year. Both the number of funds and the aggregate dollars being raised after each year setting a record over the last decade. But one of the other things I really want to point out is the average fund size. Now, we saw this trend starting in 2019, and it was partially because as we were coming towards what was perceived to be the later innings of the cycle, we saw cash starting to aggregate with the large players, the very large real estate funds. And we saw more billion-dollar funds than $250 to $500 million funds. Well, that trend accelerated and dramatically in 2020. And this leaves a lot of sort of the mid-tier, the opportunistic, and the variety of real estate investment funds sort of looking and starved for capital, as the big players are attracting most, if not all, the capital going into the market right now. Now, that concentration of capital is believed to be stability is found in those larger players, and in times of uncertainty, investors believe that these players will be able to weather any sort of continued recession that goes on at a global level. But we will see what happens there. It's going to be a challenging time for many of those mid-tier investment funds in real estate. Passing it back to Annemarie, she can talk a little bit just about the distress we saw across the market as we kind of outlaid, and you can see it reiterated here. Annemarie?
Absolutely. And I want to urge the audience to think of three themes as we continue through this. It's a couple we've already mentioned. One is velocity, and we're going to see more details about the velocity of what occurred to commercial real estate as a result of this. We're also going to talk about some lag effects. We're going to talk about some things that we expect to happen that the data don't necessarily show today. Because of a third theme, and that is a theme of relief. Because of a lot of work that lenders, special servicers, and even government programs have provided here and abroad, there has been helpful relief, which is actually making some of these statistics look better than we expect them to stay. Okay. In this particular slide, what we're showing you here is data from Trepp's database of U.S. bank loans. One of our data sets on commercial real estate is a set of data that represents just under $200 billion worth of loans from U.S. banks that range from community banks with a regional focus to very large institutions with a national footprint. And in looking at that data, which we aggregate and anonymize, and looking at that database, we're taking a view here to a point that Troy mentioned earlier, which was the great state that commercial real estate was in before all of this happened. This particular chart starts with the fourth quarter of 2017, and we're looking at very low delinquency rates on the whole in several different property types that represent loans from these banking institutions. When you get to quarter two, quarter three, you see the huge uptick in delinquency in lodging and retail, who have been very seriously impacted by all of this. But what is masked in this data so far, and it's not revealed quite yet, is a problem that we expect to emerge over time that we will see in office, which is a deepening of delinquencies and issues in that sector. Troy, why don't we go to the next slide. This is some other detail about delinquencies in loans in commercial mortgage-backed bonds. And this particular slide begins with the period just before the great financial crisis that occurred and started in 07, 08, et cetera. And it shows all property types. The dotted line is all property types, and then the individual colors are reflected. When you get to the 2020 period on the far right side, you see the precipitous uptick in delinquencies in loans, in lodging, in retail, and generally overall. And that again shows the velocity of what occurred in the pandemic for commercial real estate versus what had been a slower and lower progression of delinquency rates that had taken hold from and after the onset of the great financial crisis of the last decade. That is a very important contrast, again, one that Troy mentioned earlier about the contrast between what's happened now and what happened then. Looking further into other continued distress in CMBS, we track about $550 billion worth of loans in the private label CMBS sector. And what's very interesting, when we refer to the velocity of what happened to these loans because of the onset of the pandemic, it's impossible not to compare it to what happened during the great financial crisis. The peak of delinquencies in loans in commercial mortgages in CMBS deals that occurred as a result of that crisis was in July of 2012. Now, we're talking about a crisis that began in 07, 08, and it took years to reach a delinquency rate of 10.34%. We reached the rate of 10.32% at the end of June of this year. That took place from the onset of the economic lockdowns and shutdowns that began in March until June. We reached almost the same rate that it took years for us to reach during the great financial crisis. Again, huge velocity. Now, the next data point on this slide is the current overall delinquency rate, which certainly appears like a piece of good news, but that's where that other theme comes in. The reason the delinquency rate has dropped over the last 5 months for loans in CMBS has been because of relief. This represents all of the forbearance, all of the extensions, all of the relief, all of the creative solutions that lenders, servicers, and special servicers have been tirelessly working to do ever since the onset of this. They have tried to provide a form of a bridge between getting through this pandemic and getting to some degree of normalcy where some regular pattern of business and usage of these properties begins. And that's why the rate is lowered, because once that relief is underway, those loans get marked current, not delinquent. So while it appears to be good news, and I wish I had only good news to share, I do share that data point to you with caution, because that is a function of forbearance, which will not last forever. So those data points are ones that we have to watch for. And to Troy's earlier point about the great state of commercial real estate over this last decade, look at where our overall delinquency rate was just a year ago last month, less than 2% delinquency. So we expect continued distress in CMBS. We know that the forbearance and the relief and the interim solutions that have been offered cannot last forever. And we're dealing with, the juxtaposition of the timing and continuance of that versus what is still a sustained pandemic situation. And notwithstanding great news about vaccines coming, the reality that it is going to take months before a large swath of the US population has even been vaccinated to bring down the risks that we are living through right now of that pandemic. So this is
one positive also on the relief piece. So while I agree that the private market has been doing a phenomenal job of working together, I think the lenders and the landlords and tenants have worked more empathetically in the last 8 months than I've ever seen in my career. There's also been government subsidization, some of the largest stimulus packages, as Annemarie alluded to. There's the details, I believe, are getting released today. I've yet to get a chance to read them on the additional just over 900 billion that is coming. Again, President-elect Biden mentioned this as a down payment of sorts on the future stimulus that needs to come, which will be a sign of relief for a lot of the business community as there were concerns with jobless claims falling, the stock market at an all-time high, that the underlying economics, the core economics of what's going on in the market, the jobless claims, the shifting economics of the businesses and the core businesses that drive our economy, they're not there yet. And so it's good to see that the politicians are not taking a few indicators of positive news of the economy and pulling back on the stimulus. So that stimulus is very critical to keeping this rate, as Annemarie pointed, down below double digit and into a more normalized rate. We're still clearly well above where we were in 2019, when virtually everything was pointing up for real estate, and quite honestly for the U.S. economy, while slowing, everything was pointing up.
Absolutely. We can move to the next slide. This particular slide focuses on appraisal reduction amounts and the cumulative impact of them. Those ARAs are estimates of potential losses of a loan resolution, and we have seen them steadily increasing. They've increased notably since the start of the pandemic. And what we've done here is another compare between how this stat increased during the Great Financial Crisis and how it's increased now. And while we're not yet at the same level that was ultimately reached in the Great Financial Crisis, once again, we're showing how quickly, over a matter of months, we got to a rate that's roughly about half, a little less than half of what we ultimately reached in the Great Financial Crisis. So once again, we believe that the current levels are only marking the beginning of what is probably going to be a steady increase in appraisal reductions. And this is very, very critical as servicers work out loans that for borrowers that can't meet their debt service requirements. This is another statistic that we unfortunately believe is going to increase, and that we anticipate rising losses on these loans over time. We can move to the next slide. We looked at a global view on this slide for the leveraged loan default rate rising. And what we do want to report here is that while this rate of defaults for leveraged loans, both in the US and in Europe, has certainly gone up over recent months, it actually is significantly lower than where we were at similar points in the last financial crisis. But once again, it goes back to the theme of relief, as Troy pointed out, not just individual covenant relief in the case of these loans and other forms of relief given, but also in these cases in both the U.S. and abroad because of government programs that were hugely helpful here. So a stat to watch, a stat that has been muted in its severity because of the relief that's been provided both publicly and privately. So another important evidence of rising loan defaults that we do expect to continue, unfortunately. We can move on. Yes. Oh, go ahead.
Yeah, I was going to say, so, I mean, we've painted sort of this dire picture, you know, the relief has been there, the people have been working together, there is capital in the market, but it's critical that we continue to see that working together. I know one of the things Annemarie and I talked about that we often find challenging to convey to people is, you know, you looked at the last decade of real estate and, you know, many people's interactions with real estate as a consumer, as a tenant, is that these landlords are doing so great. I mean, who cares if they're getting hurt? They've done so well for so long. Like, this is, you know, this is just a rich person problem. This isn't an economic problem. But one of the things that you forget is, as I mentioned, many of the businesses in that K-shaped recovery that are failing are the family run, the regional businesses, those local shops, those local coffee shops. They're having the challenges there. And while they're getting some federal relief, and it's not the same. And where they're really going to be able to dig out is when they can get to some of those small business loans that come from, or any of those sort of business lending that comes from these banks. And when you look at the banks, the way that the banks are able to backstop that is often through their commercial lending program. Their commercial loans are generally their largest asset on virtually all major U.S. institutions. And if that core asset is being rocked to its core, then it's challenging for those banks to take on the risk profile that it will need for these businesses to weather the next few years as not only do they come out of the COVID pandemic, but many of them need to transition their business model, where online delivery is a big challenge, and the logistics and the distribution channels. They're going to be pivoting on where they're located, for instance, because of shifting demographics. So there's a lot of uncertainty coming through, and there's going to be needing of capital to help businesses go through that. And if we allow these mortgages to just fall off, as some people suggest when you have side conversations with them, it puts a whole wrench into the system. So these are all intertwined.
Absolutely, completely agree. Absolutely. I think what a lot of people might think it's a rich person problem. It's a big institution that owns the building. It's a rich person who doesn't have to worry about it. But the reality is there's an enormous two-way street, because as much as that building landlord owner wants to get that rent from that tenant is also reliant on that building being able to pay its overall mortgage, and that building not being foreclosed upon, and that owner being able to support that building so that that is a functioning, operating building. You have tenants fighting to keep their businesses alive, but the fact their building, the overall building of which they are only a part, also is fighting to stay alive as well. And that interdependency is so important. And I think the other thing that is very relevant is when we think of issues with lodging, which we're about to go into in more detail right now, there is a whole ecosystem around that hotel. When we don't travel, we're not only not spending money in that hotel, but all of the other related expenditures, whether it's for leisure or whether it's for business, the entire ecosystem of spending, purchasing, dining, other shopping that happens as a result of a trip It's not just can that hotel stay afloat, but what about all of the other businesses, not only the employees in that hotel who rely on that for their livelihood, but all of the other related businesses that are dependent on travel to that area and travel to that hotel because they are in that vicinity and have always benefited from the diners, the shoppers, and the other needs of travelers, whether it's business or whether it's leisure. So everything is connected and related. And that's what's so critically important as we look at the effects of all of this on all of commercial real estate. Absolutely.
Yeah. Let's dive into hotels. You have some good CMBS numbers here on this. Why don't you dive into the hospitality?
By all means. So, we've spoken about the fact that due to the pandemic, travel, whether it's work or pleasure, has plummeted, absolutely plummeted. And we just spoke about the ecosystem that's part of all of this. What we've done here is we've taken a look at what occupancy was just before the pandemic and how average occupancy has dropped. And this has happened regardless of the type of lodging that we're talking about. So the yellow line on the left-hand side represents all lodging, but you see all of those bars dropping, whether it's an extended stay hotel, a full service, etc. It's all dropping. And then another stat that makes sense with occupancy dropping, delinquency and special servicing is on the uptick. And again, that is happening. And what's interesting is a lot of people say, well, lodging was hit the worst and most directly and first, but it's probably going to recover the first too. And I think the real outlook for lodging, Troy mentioned the estimates of when some degree of normal airline travel is going to return. That's a few years away. I think with lodging, you might begin to see some upticks in lodging early on, but again, I wouldn't take that data as sign of the start of some complete recovery, because to a point mentioned earlier, some habits, some practices are always going to be altered by what has occurred. I think a lot of businesses are totally going to rethink how much business travel they ever have to do again, even when we reach a point when we all feel safe and comfortable doing it again. And so while lodging may certainly begin to show some signs of recovery after we've all been vaccinated and we begin to feel safer and there's a bit of normalcy that starts to kick in, I don't think that completeness is ever going to return, because I think it's going to forever change some practices around the need to take on the time and expense of business travel. I also think
to bring that home for a moment there, Annemarie, looking at our own company, we spent over the same period prior year almost $80 million in travel, in business travel. And this year we're at just about $10 million in that same category. And most of that's covered by internal. We have obviously a lot of client travel that we hope to resume again, but even client travel will slow down a bit. And it's fascinating because, our CFO was presenting on it. He said, I don't know that we're going to stay at 10 million, but I'll tell you what, it's going to be a while before we go back up to 80 million, because we've seen the way that we can leverage technology. I mean, I can't tell you how many times, I'm flying to Chicago for a 8-person meeting or something like that now is just a WebEx. And
exactly.
It's not exactly the same, but, adding the video, everybody's sort of comfort level, everybody basically got a crash course in Zoom, or we're on GoToMeeting today, or, any one of those platforms. And so we've all gotten more comfortable with it. And I've seen statistics of just even buying, Bain Consulting did some analysis of what our business executives, what price threshold they're willing to buy. And the amount of business executives over the last 6 months that have said they're willing to buy $1 million plus purchase orders via WebEx or via a video conference has skyrocketed. And so some of those trends are going to continue. So many of these smaller traveling are not going to necessarily bounce back. And then the other one that really hurt fast, and why, you saw extended stay was holding a bit stronger because that was more of your workforce housing. People were still doing that. Truckers were still transferring across the country. But the hospitality that was focused on conferences, that fell dramatically so fast. And that will be one of the last that the restrictions are alleviated. When you look at it, from my hometown in Boston, the Biogen conference was a super spreader event very early on in the pandemic. And that had travelers all over the world coming to Boston. And at one point, 70% of the cases in Boston were traced back to that Biogen event. So it's going to be a long time before local governments in many of these cities and many of these major, destination areas for these conferences will open it up to have thousands of people sitting together in a conference room. And that's why things like the vaccination and other treatments are so huge to getting us back to some normalcy, because I do hope some of those conferences come back. I think the type of networking and the interpersonal relations that you can build there can't be replicated on a WebEx. While business can be done with those, it's a little bit different.
Yeah, completely agree. And I think a thing to think about too is we're not all going to equally feel the same degree of comfort at the same time.
Right.
To create huge waves of things returning back. I speak to many people, and I just was recently out dining outdoors at a restaurant with someone who said it was the first restaurant they had stepped foot into since March. And this was somebody who lived in the city and had not ventured anywhere to dine, even outdoors. And so there's going to be very different, varying degrees of comfort level. I know someone who said to me, I can't wait to get back and talk to my prospects and have a trip. I'm willing to take a trip. I said, yes, but is the person on the other side of the table willing to meet in person?
Right.
So there's an element of personal fear that is understandable, and that's going to also be a factor in all of this as well. Yeah.
So continue through, and we'll pick up a little bit because we do want to get to the other sectors. Similar story with the revenue per room, available room, took a precipitous drop the end of March. It started to tick back up as we saw summer travel. This chart doesn't extend through the last couple months, but it started to dip back down as we get into the winter months, and things are slowing down and travel is starting to slow, and the rising cases have been going on. I know you have a little bit here showing just a year over year and how much lodging. I mean, when you look at lodging here compared to the other asset classes, it's startling in some ways.
It is.
If you want to touch upon this slide real quick.
Really quickly, another example of the way lodging has just borne the worst brunt of this so far, with its decline, the huge decline in occupancy, as well as a huge drop in debt service coverage for lodging. So again, staggering numbers, undoubtedly the worst hit property type as a result of this pandemic. But moving on, not the only property type that's suffering.
No.
Okay.
No. Retail is definitely, retail was going through, I used to call it a renaissance, and I still think it will bounce back to a renaissance. It was, these lifestyle centers, this mixed use properties that brought in entertainment facilities, and they made them really like a family destination, kind of different than sort of these malls that I used to growing up. You see this picture here, where it was, the experience was the shopping, and that was about it. Every now and then, maybe they had a little display in the center atrium, but now the malls were just evolving to be, they had escape rooms and theaters and destinations that were really amazing.
You're absolutely right.
And now we're curious to see where that bounces back. I think there's a lot of uncertainty. I mean, we can talk a little bit here. Can you dive into the occupancy and delinquency rate?
Right. I mean, as Troy pointed out, retail was having its challenges, but the creative holders of retail properties were applying a lot of things to them to pick back up traffic in certain retail locations. Here again, we see a drop in occupancy rates across a variety of types of retail properties. And we also see that, again, when you look in the March timeframe over here, March, April, May, you see the spike in retail CMBS delinquency rates. While you see it appear that some of those rates are coming down, that's a function of the relief that we've spoken to. What's important to notice here is that the retail that has been flourishing through the pandemic has been the neighborhood centers, the convenience centers. If you think about your own habits during this pandemic, were you going out to buy clothes, or were you going to your CVS, Rite Aid, Walgreens type store to pick up some essentials? You know, what did you find yourself using? What was helpful? What provided you what you needed? That tells you a great deal about the retail that has survived well through this, and will probably always will, because that won't go out of style. But in general, decreased occupancy, increased delinquency rates help somewhat by relief, but more problems ahead for retail.
Yeah, no, absolutely. And real quick, Annemarie, we do have a question from the audience regarding any forecasts regarding property tax liabilities and payments. That's a great question. We don't have any slides on that. We do know that there's most of the state and local governments have had significant layoffs. They've had significant budget challenges and constraints being pressed upon them as they have been trying to provide relief to their constituents. Many of them have had to support online or hybrid schooling platforms that required investments in equipment, additional teachers. I know my own town is still trying to hire additional aides to help with the online teaching. So there's been a number of budgetary constraints and limitations on the state and local level. And we are seeing real estate taxes tick up in certain regions. And in interesting regions, I have a colleague who moved to Nashville recently. And while real estate taxes there continue to be low, they're actually increasing. It's been one of the hottest markets in the country as far as attracting people. And they're looking at a 30 to 40% property tax bump at a residential level. He moved from a higher tax state, so he wasn't as concerned, but as you can imagine, it's a significant jump for many of the local residents there. And so property taxes are definitely going to be a challenge and being increased. And that's why some of the SALT tax relief that people are hoping may come out of the Biden administration will be something to bear in mind. But yeah, property taxes are definitely going to be a challenge going forward, as everybody will be looking to recover over the next 5 years what the coffers that have been emptied to try to keep us afloat for a while. Continuing on, you know, we look at the retail absorption rates, and while we continue to see very strong absorption up until about 2018, 2019, then it started to peter off, and while delivery remained consistent, we saw an extreme dip in absorption and continued vacancy. And we continue to expect to see that through till 2022, as retailers are that lag effect that Annemarie keeps referring to. They've been holding on as best they can in many cases, but at some point, forbearance and government subsidies are going to wear off, and some of these retailers will be unable to survive. We do expect to see it start to bounce back up as people get more comfortable and vaccines are more widely spread. And as such, some of that experiential retail will start to absorb back up, and we'll start to hopefully see those retail centers come together. There are some trends that we've seen that people do still want to buy in person. While online shopping has accelerated dramatically in the last 8 months, there's still a place where people want to shop, eat, and play and be together. And so that will happen, but we're a few years out before we see the absorption rates sort of bounce back to where we had been.
Yeah, and a couple of ideas on retail, Troy, because you mentioned, what becomes of some of the initiatives that good retailers were tackling to try to revive retail in recent years. It makes one wonder if it takes people a while to feel safer getting back on planes and having leisure trips, that destination and that experiential center that many retailers were trying to make out of their site might satisfy a bit staycation tendencies. Also, what I think we're going to see a lot more with retailers who have bricks and mortar will be some things that came in very handy this year, and will continue to have appeal as people remain concerned about disease and germs. But, curbside pickups, contactless ways of paying, low touch stores, etc., are probably going to become a bigger and bigger wave of the future, so that when you make that 5-minute run for some convenience items or some other items that you want to look at, you feel even safer in a store because of those features than you might have 2 years ago. So just a thought around some of those trends about retail. Okay.
Yeah, no, absolutely.
Yeah, and it's impossible to talk about what happened with retail during the pandemic without acknowledging how much more online shopping we have all done. It has been the thing that added one more nail in the coffin of so much bricks and mortar retail, and it's been the huge trend of 2020, and it has made warehouse and industrial type properties the hottest properties around. So this is a very, very key area, and this type of utility of properties like this, or properties that can be adapted for this purpose, is going to be a continued trend we're going to see for quite some time. In addition to the safety of having a lot of things delivered to you, everyone's learned about convenience. And so our prediction is industrial is going to remain an important and viable part of CRE for quite a long time to come.
Yeah, absolutely. And I mean, it's just a personal level, I think I told you this this summer, actually. We talked about it. I laughed. My wife and I use Instacart to do our grocery shopping now. My wife and I both work, and we have 3 children, all under the age of 7, and 3 young boys. So we love dearly, but if you've ever tried to go shopping on Sunday with 3 young boys, you realize the challenge that is as they're running around. And Instacart gives you this little, it gives you your data points of, how much you shop on them, and it estimates the time that it's saved you from shopping, but it estimates it on these. I see the Instacart delivery people, there's these, young 20-somethings, unburdened and unfettered by children coming to deliver. I'm like, so you need to multiply that by 3x to get at how much time you've saved us and given us back on the weekend. So you're right, that convenience factor is critical. I do, because I love having questions come in the chat. We only have about 7 minutes left, so if you have any more questions, please put them through. But following up on that tax question, the property tax question, they asked if they're specifically regarding commercial property with regards to property tax. That's going to split. So I think industrial, where it's been hot, multifamily, where it's been very hot, and residential, where home prices have gone through the roof because of some of the demand. That's where the property tax shifts are going to be. We'll likely be targeting on that industrial and residential side, where office and retail, one of the things that most local governments never want to see happen is office and retail go dark. And so they are going to be more lenient and forgiving on and provide tax abatements on those types of asset products because having them go dark is a real blemish for the community. So here's just a quick chart jumping back into the industrial. You can just see the amount of industrial underway as a percentage of construction. We're up to almost 2% of the total available industrial is under construction, and we expect that to continue to climb through 2021 and beyond. Not only as online shopping has continued, but there's been questions and comments about resiliency of supply chain, as we saw what happens when all of a sudden we shut off trade between certain countries and how interdependent our global supply chain has been. And there's been a shift now towards making sure that at least supplies and warehousing and logistics are provided within the local country, and the U.S. is not exclusive to that. And we'll potentially see some more manufacturing. That will take longer to bear out. There's longer investment there than warehousing, but we expect industrial to remain hot for the foreseeable future.
And
the one that's really, go ahead.
One quick note on industrial too. I know of a lot of people who are looking at adaptive reuse of structures. Mm-hmm. So I believe there's going to be a lot of activity around rezoning and re-permitting and recoding for buildings that might be converted to warehouse versus their current usage, just as a thought going forward. And that is actually part of the issue you're about to begin talking about right now with office. Yeah.
Yeah. And that you actually just sort of answered a question that came in. Are there any physical changes that you see in industrial spaces and facilities going forward? A couple things. I see industrial becoming part of mixed use facilities. So where you used to see just retail, residential, and office, there'll be an industrial component so that they can provide that last mile delivery. We're seeing new and creative ways to use the industrial space using robotics. You can compact the industrial space a bit more. And we've also seen more proliferation of multi-storied industrial space as they're looking to have it infilled. It'll be interesting to see if that continues, if trends of people moving to the suburbs continue. I wonder if that multi-story will become less prevalent because you'll be able to build the traditional single-story industrial we have seen predominantly out there in suburban and rural areas. With just a few minutes ago, we do want to talk about office, which is probably the most laggard, but the most concerning one, or the one I get the most questions about. What's going to happen with office? So how is office occupancy going to work when is everybody's going to work from home? We're never going to go back to the office. Or we're all going back to the office. It's somewhere in between. I think we will have more working from home, more percentage work from home. But you have a little bit here on the occupancy rates and some of the delinquency rates going on in office.
Yeah, and I think what an important message here is don't be misled by the occupancy rates. We know that corporate tenants with important lease obligations, for the most part, have certainly been paying their rent because of the importance of that contractual obligation that their company has. But this level of occupancy rate does not mean that everyone is in there using the office. And just as we discussed the fact that businesses are going to take a look at what they've spent on T&E, businesses are going to look at what they're spending on office space versus how much space they truly need to be using on a regular basis. And as they focus in 2021 on when do they really go back and how do they go back, we know already that the sublet market in Manhattan, for example, is flooded with space that office tenants would like to unload. And I know of many companies that are trying to renegotiate their leases now. They're trying to let go of space now ahead of renewals over the next few years. So we mentioned the word lag a few times in this presentation. One of the issues here is that we expect you're going to see office and office news, office delinquencies lagging the core moments of this pandemic, because as eventually there's more attempts at a return to normalcy, there'll also be an addressing of the reality that businesses do not necessarily need all of this space.
Yeah, no, absolutely. And the other thing we're seeing and hearing a lot from our office landlord clients is that while the vacancy rate is staying flat, the rent growth rate is projected to dip off, and we're going to continue to see that decline. I've had a number of clients that have come back to me and said, we're keeping our tenants and they're willing to actually extend their leases, but they want a 20 to 30% rate reduction. And in many cases, the office landlords are acquiescing. So we talked about some of the forbearance that's happening within the debt markets, but you look at that forbearance happening within the leasing markets in many ways. And so that's going to continue to become an issue when you look at debt service coverages on these loans and refinancings that'll happen 3, 4, 5 years out at new rental rates where nobody's seeing a one-time dip of 20% in their rental rate projections. You know, oftentimes you're seeing a multiple of 3 to 5% rate increase annually. So that's going to be a big challenge, and that's also going to lead to some of that lag effect. I'll touch real quick on housing as our last thing, and I'd like to end on a bright note. So, you know, one of the things that we have seen is multifamily continues to be extremely hot. While there was a dip in May, a lot of that due to some of the sort of shutdowns, some of the pauses that were happening, we're continuing to see that rise back up. There is a focus to move to, you know, the housing market has been extremely hot, but there's been an undersupply within housing for a long time, and home ownership rates remain low. And multifamily will continue to see an attraction. As people will want some of that urban feel, but maybe in a more rural and affordable area. So that we'll continue to see some multifamily development going forward, as well as housing. And we've seen a lot of single family real estate investment at the private equity side of things in real estate investing. With that, we are just at the top of the hour, Annemarie. We always get going. It's always a pleasure speaking with you. We could fill the hour and then some.
Exactly.
But overall, there's a lot of lag effect. It's a lot of challenges, but I think real estate is a resilient asset class, and in a few years we'll be looking at the transition and the renaissance that's happened among the asset classes. What are your thoughts going forward?
I agree. I think that while a lot of this will create opportunities for owners and investors in distress to really recreate and retool and renew and refresh. And I think the lessons we learned about the pandemic will remain with us, but I think that will create adaptive uses of real estate that will be useful and responsive. And I am optimistic that it is resilient and always a fascinating part of our economy.
Yeah, without a question. I think the saying is, when there's blood on the street, buy real estate. And but it's really true. We're actually seeing that some of our real estate investors are buying, actively looking for investment opportunities across Europe and across the United States, and not in distressed markets, but in Chicago, in Germany, in France, and what have you. So we're seeing that already. I have to say, as a New Yorker, I do agree with Jerry Seinfeld. I don't think we have seen the last of New York. New York is going to bounce back. We've bounced back after 9/11, and we're going to bounce back after this one. But I'm convinced of it. So this concludes today's webinar. Thank you very much to our panelists for your insights on this super interesting topic. And thank you to our audience for joining us. And a quick reminder, if you are a member of the EACC and you would like to connect with any of the other participants of this program, or if you want to reach out to the panelists, let us know. We're happy to help connect you with anyone you would like to talk to. And with that, enjoy the rest of your day. Thank you so much.